Technical difficulties. Come on now. It's working. It's doing the thing. It said it timed out. So we are trying one more time. Okay.
Looks like we're live.
Beautiful. Perfect. Hello and welcome, folks. We'll try that again. Hello to everybody who's on the webinar with us. We're so grateful to have you here. And also to YouTube. Great to have you as well. Welcome. All right. Let's see if I can open up everything. And I just want to make sure that, okay, you can all see my screen. Wonderful. Okay, folks, we've got a super great, wonderful, awesome training in here for you today. This is, a lot of people request this training. We train on credit banking, every week. Obviously, being this is the 20th week in a row that we've been training on credit banking. And what is credit banking? Credit banking is synonymous with a lot of other terms. You might have heard of velocity banking. You might have heard of cash flow banking, mortgage sweep strategies. There's it goes by a lot of names, but the underlying principle is that you are banking through your lines of credit. And each week we break it down into different issues, or different subject matters.
Yes.
And today is a really exciting one because we're going to hit on credit banking with business credit, or business credit with credit banking.
This is exciting stuff. I love this one.
But before we go any further, I have to always make the lawyers happy, right? Got to keep them happy. So I need you to know that I'm not a licensed attorney, accountant, financial advisor, or broker, or any other licensed individual. And you can read the rest, because what it means is it's your responsibility to do your own due diligence, because what we share here is, as successful business owners who have worked with literally hundreds of clients, we're sharing with you financial strategies that have worked for us and for them, but it's really incumbent upon you to hire competent, legal, local professionals, attorneys, CPAs, to make sure that the strategies that we go over will work for you in your specific situation. Sound good?
That sounds good.
All right. Hello, I'm Joseph Smith. If I haven't already identified myself, this is my business partner, Ray Fleming.
Aloha.
We are the wise guys in ties, wise in the ways of helping you with your credit banking strategies, getting out of debt. And then not only just getting out of debt, right? You start in the negative and we get you all the way back to zero, but we're not comfortable or satisfied at zero. And then we want to show you how to build wealth and go beyond that. So we help give people the tools and the resources that they need to build and grow their dreams. Whatever God put you on this earth to do, that's what we're here to help you to do. And that's our contact information. Should you want to move forward working with us, call us, email us, go to our website, schedule a free 30-minute consultation. We'd love to work with you. So, what is the lost American dream? Well, I liken it to the Indiana Jones movie, when he's sitting there and he's trying to get that golden idol, and the music's rising, and it's like the American dream, it's just within your grasp. And can you get it? That financial freedom where, everybody wants to have. And in that situation, he maneuvered across all these different booby traps and got away from the spiders and the spears and the bottomless pits. He did everything right. And then it still all comes crashing down on him, right? Because what about you? Have you done everything right? Did you go to school to get good grades, right? So that you could then one day go to college and get a degree, right? So that you could get a job, to get a house, to get a car, to get married, and to have 2.3 kids. I mean, did you do those things? How did that work out? For a lot of people, they're stuck in what Ray calls the 40-40-40 plan. You want to elaborate on that for them?
Ooh, the 40-40-40. We haven't talked about that in a while, but some of you may have heard it, some of you may have not. 40-40-40, it's designed for us to live in a way of working for 40 years of our life, 40 hours a week, and then actually it's to get 40 hours a week, or
yeah, you work 40
hours a week for 40 years of our life, to ultimately retire on only 40% of what we're actually making.
Retire on 40%, but what if we're living paycheck to paycheck right now?
That's a tough situation. Now, unfortunately, if you haven't planned for retirement, you've planned to fail. And a lot of us, we are too busy going through just the motions of life and looking at the stresses of today's finance, that we kind of we rely on our 401k, or our traditional IRA to build for that future.
But does it? You talked about retiring on 40%. These retirement accounts that we have, these 401ks, they're not providing us the financial freedom that we're looking for.
Well, they're definitely not. And like we said, if you don't plan, you've planned to fail. And just simply, the 401k wasn't even designed to provide enough.
So if we're not financially free, that must mean that we are actually imprisoned. We're enslaved. We're shackled. But I mean, who's the dictator, or who's the potentate, or who's the jailer that holds our bonds?
The banks, the lenders,
Mm-hmm.
the financial institutions,
the
refinances.
I mean, gone are the days of the whips and the chains, and now it's debt and bank. If you can't pay it, bankruptcy and.
Yep.
And bankruptcy, with a lot of jobs today, if you have a bankruptcy, they're going to let you go.
Pretty much.
If you have any job where you handle or work with anybody's money or credit, then and you have a bankruptcy, a fresh bankruptcy, your job's in jeopardy.
I just don't remember when they taught me how to avoid bankruptcy.
Folks, there's to achieve financial freedom. I mean, we all are familiar with what keeps us, right? What keeps us from financial freedom? It's our out of control debt, right? We've kind of been alluding to that. But the only way to get out of that debt is to have a goal. But I mean, just to say I want to be financially free, what does that mean? And so a lot of people, they don't actually take the time to quantify what it is to be financially free. So let's take a look at that. To be financially free. Well, we define that as financial freedom is when your passive income equals your monthly expenses. Would you take a minute and just explain what passive income is?
So passive is really where you have done the work one time, set something up, and it continues to pay you over a long period of time with very minimal management. True passive income is just kind of set it and forget it, but very little management.
Absolutely. I mean, my favorite passive income is our rentals, right? Because that money just comes in every month without us having to go and work for it.
And the amount of work that actually requires is very minimal, because we put the systems in place, put the management in place, spent the time to make sure we're working with the right management. I got a call today because they're working on a gate, and all they needed is they've already done all the groundwork, and then they come just to get that final authorization. This is what we got. This is what we need. Can we just go ahead and take care of it? Yeah, sounds good to me. Go for that. And that requires a 30-second phone call, but that's happens once every 2 months, maybe, if that.
Well, I love it. I love passive income, and what I want to do is I want to help our folks quantify the equation that we use to figure out their financial freedom goal. And it's when we take your monthly expenses, whatever those are, and if you can subtract your passive income from there, that will equal your financial freedom goal. So let's put that into an example. If your monthly expenses are $3,000 a month and your passive income equals zero, right? Then your financial freedom goal is $3,000 a month coming in, right? Because if you had $3,000 a month coming in that you weren't working for actively, or like you were saying, minimally have to work for, then you would then be free. So a lot of times we talk about, well, what is real wealth? Well, sometimes there's being financially free, and then there's being wealthy. This is financial freedom. Wealth happens when you then exceed this, right? That's when you begin to build wealth, everything above and beyond your total expenses. So again, these are some of the thoughts that we need to already have. I mean, we need to have the destination clear in our minds before we set out on the path. Otherwise, we're going to get lost along the way because we don't know where we're headed. And so once we know what our financial freedom goal is, how much money do you need to invest to create the passive income needed to reach your financial freedom goal? Well, again, I've taken the liberty to come up with a nice little formula for you. Very simple. You take your financial freedom goal and you multiply it by 12, and that'll tell you what your annual expenses are. And then you divide that by your rate of return, right? And then that'll equal the total investment amount. Now, your rate of return, that's just simply when you put money out there. Like if I put $100 out there, and if I want to make 5% on that, then I want to invest $100 and get back $105, and that would be a 5% return on my money. So for me to find the right investments that will create, because it's investments that create passive income, whether you're investing in real estate, some kind of mutual fund, or something that pays a dividend, or anything like that, there's a certain rate of return. The larger the rate of return, right, the higher that rate, the greater the risk, right?
Absolutely.
The smaller that rate of return, the less the risk. I mean, is it
well, I guess there are things that you could invest in where you don't get a very good return and it's a terrible risk or it's a horrible risk.
I guess, but I was kind of likening it to a savings account. If I go put my money into the savings account, it's supposedly very safe as long as I stay under my FDIC insured limit, right?
Right. But
Okay.
you're going to get a terrible return.
I'm going to get a terrible return, anywhere from, I mean, at best 2%, but probably worse than that, 1%.
No,
So, but maybe I want to invest in business futures, right? Which could have these crazy like 200% returns, right? But I could lose everything.
Absolutely. Yeah.
Right. You know, and as fast as I snap my fingers, you can lose it that fast. You lose it so fast that there's no way to pull out any of the investment, right? So very risky stuff, right? So you have to determine what your own risk tolerance level is. What types of investments are you comfortable with? And the only way to do that is to get educated about it, because the last thing I want you to do is go give your money to somebody else to go manage it for you, right? I want you to actually become educated. And that's why you're here watching this YouTube channel, because you're the smart, educated kind of people. Those who are here in our mastermind as well, you're the kind of people that want to do this yourself. So get educated, learn the type of investment strategies. Ray, the property guy over here, I think your investment strategy is real estate.
It is.
Which is mine too. We're in business together. I also happen to like money lending and other forms of
I just copy the successful. That's all we got to do. If you look at who makes the most money, banks. Copy what they do. They invest, they will lend on real estate, and that's pretty much the only thing they like to actually go in on with you. They like to go into real estate with you. They'll lend on that all day long. So might as well get into real estate.
Absolutely. Well, okay, so we were talking about this formula here. Let's put it into an example. If $3,000 was your monthly expenses, and you multiply that by 12, right, you're going to get $36,000. If you then chose a 10% rate of return, so your goal is to make 10% on all of your investments, right? How much money would you need to be able to create the passive income that you desire? Well, at a 10% rate of return, you would need to have $360,000. Now we're starting to actually quantify what is our financial freedom goal. What could I do? Could I invest in some real estate? I mean, is there real estate out there worth $360,000?
Absolutely.
I mean, aren't there a lot of houses out there? You're going to find 4-bedroom, 2-bath houses like that all over the place. Some 3-bedroom, 2-bath houses. I mean, that's if you're in real estate. And then, but you know, $360,000 is a lot of money. But compared to, like, if you wanted to build up your retirement fund so that it paid you 100% of what you needed for 25 years, you'd need to have like $7 million sitting in an account. You know what I'm talking? Earning a certain interest rate. I mean, there's people, I've seen people, it depends on how much you need, right? Do you want to get by on 2,000, 3,000, 5,000, 10,000? You need different dollar amounts, right? But I've seen that range anywhere from needing 3 million in an account to $7 million in your retirement account that's still earning a small rate of return just to be able to retire. I mean, so if you go to the financial planners out there, right, they're going to tell you need to build that much money. So which sounds like an easier goal to reach? 3 million, $7 million to invest, or 360,000. I think that sounds much more achievable for somebody, especially if you've got your life ahead of you to live.
It really is.
So how do we do this? So now that we know where we're going, but you know, life happens. Life hits you, comes at you sideways, and you're not even expecting it. And before you know it, you've racked up a ton of debt. And then our path to get to that $360,000 has been ripped up in this map. And how do we get there? And now we're a bit lost and we're confused. And so this is what we do each and every week. We take all the pieces of this map, we flip it around, and we bring it all together. And so we work on your budget, and we help you understand how to increase your income, how to decrease expenses. And then we work on understanding the math behind the lines versus loans, the banking products that are out there that everybody uses, and how we can understand how expensive they are, and really how to use them correctly to combine them so that they can pay each other off very quickly. And that is the credit banking strategy. So what we do is we put the whole map together each and every week, and we take off on our airplane, and we're learning how to budget, and then how to do lines versus loans, and then we learn the credit banking strategy. Each and every week, this is what we're doing. And credit banking strategy is phenomenal because you're really accelerating your debt pay down by pushing all of your income and expenses through your lines of credit. What this ends up doing is it decreases the total number of payments that you have to make, because you start taking large chunks of very expensive interest out of these loans that are amortized in such a way where all the interest is front loaded. And what you're doing is you're putting them on these lines of credit, and then the lines of credit, which are amortized completely differently through a simple APR. So it's much more inexpensive. So we pay down the lines of credit, and then we do it again and again and again. And that's this credit banking cycle. And it works really well, and it helps a lot of people. But we have a lot of people that still have some challenges getting started, or they're in just different situations where they can't access lines of credit. I mean, to play this game, you need debt. Do you have debt? Yep. Check. I got debt, right? What's the second thing we need?
Need some type of credit banking account. So
right.
A line of credit. A
line of credit or a credit card. We prefer a line of credit though. And then lastly, you're going to need some type of positive monthly cash flow. So you're going to have monthly income that comes in that's more than enough to cover your expenses, right? And we do have some clients that come to us at first and their expenses are greater than their income. So then we have to really look for ways to increase the income and look for ways where we can find areas where we can decrease the expenses. So that's all great. It's all wonderful. That's why you're here. And each and every week we go over the various aspects of putting this all together to help us find our financial freedom. But today, here's what we're going to talk about. Business credit with credit banking. And I've been getting a lot of requests from folks on our YouTube channel, right? The Wise Guys and Ties YouTube channel, saying, hey, could you go over this strategy again? This is a very popular strategy that we go over. And really, I just want you to understand that this strategy is just born out of the idea that if credit banking is a very powerful strategy and business credit is a very powerful strategy, what happens when you bring the two together? I mean, if these are great, and then I talked about in another video earlier today we were doing, what about overfunding insurance policies, life insurance policies, and being able to borrow against the death benefit? And we bring that in. And then what if we bring in self-directed IRAs into the mix? And I mean, before you know it, when you start combining really successful financial strategies, they can create a synergy between them. And not enough people think outside the bank or think outside the box. And that's really all this strategy is, how it really comes, where it comes from. So we're going to discuss, like we do, a similar scenario that many people, even myself, have been in. And you should know, because I mean, I've said this on many different occasions, but for those who are listening for the first time, because we get a lot of first-time folks listening to us, you should know and have confidence that you're learning from somebody who has 2 foreclosures and a bankruptcy on his record. So you can have confidence and sleep well at night knowing that you're learning from the best of the best, right? Because, why do I say that? Because I have financially ruined myself in many ways. And I had to learn, because nobody would give me a credit card. Nobody would give me financing for a house or a car or anything. I had to learn how to do this, right? I had to go out there, educate myself, meet professionals, work with professionals. And I've been very blessed to work with some of the best. Right, here's one of them. A real, make sure you always have a real estate professional in your arsenal. And so, but here's the thing. When there's people that go out there and they learn things, and there's an academic knowledge to things, but when you go out there and you have to learn it, because if you don't figure out how to do this, your family doesn't have a place to live. Your family can't eat, right? It brings a whole new motivation to you, right? And so I've been highly motivated to become the resident expert on business credit and credit banking. And I have been very blessed over the years to totally turn my life around and work with phenomenal people like Mr. Ray Fleming, and have businesses that have made $500,000 in profit. And that's all well and good, but there was a time when I was flat broke and busted, and I didn't know how to do anything. And it seemed like everything I did, I felt like a complete failure. And so I'm trying to talk to my former self, in case you might be on the webinar tonight, or you're listening on YouTube, that look, you're not a failure because they didn't teach any of this in school. You can do everything, quote unquote, right, and still completely fail. All right. The whole economy could shift away from you. You can be told that your job is non-essential. You can just have everything evaporate and fall out, and the floor fall out from underneath you, and you feel like a failure. But I want to encourage you that you're not. All right. And so I want to share this strategy with you, because this is what encouraged me when I started to put all the pieces together. This is one of the things that really, really excited me. So let's share it with you. Business credit with credit banking. Let's start with Max. Let's talk about Max here for a moment. Max, why do we call him Max? Because he's maxed out. Well, let's put a little bit more information out there. Why is he maxed out? Because his credit score is in the tank, and his DTI is way too high, and his utilization is way too high. He's been this way for over 2 years. He lives in his own home, right? And his income is $5,000 a month net after all the taxes and all of the benefits have been paid. His expenses are $3,000 a month. So he's got cash flow. He saw the credit banking strategy that we showed him, and he does have access to credit. He's got $15,000 limit between, let's say, him and his wife. They have these 3 credit cards, and each of them have a lovely $5,000 limit on each one, but each of them are carrying about a $4,000 balance. So let's time out right here and let's look at this situation, because maybe this is you, or maybe this is someone you know. This is a place where I have unfortunately been. Okay, it's very painful. So when you're forced in a situation and this, how does somebody get here? A lot of different ways, right? Could have been something happened, broke down with the car, and then there was a health issue, and then all of a sudden you found yourself having to be a caregiver for a family member, right? I mean, there's all these, it always seems to happen in threes, these weird things that you didn't plan for any of this. And then what do? You don't have the resources, so you throw it all on the credit card. Could have been another person who had this great idea to start a family business. And what did? They leveraged their own personal credit to start a business. And then the business, all of a sudden, the economy shifted away and now you're stuck, right? 90% of businesses fail within 5 years. And that's a scary statistic. But it does happen to folks. And those who invest their personal credit into businesses sometimes find that eating that loss to be very difficult.
Absolutely.
But however Max got into this situation, he's here now. And he's been living in his house. Maybe he's been in there for 5-10 years or something like that. He's got equity in his house, but because he's over leveraged his credit cards, his credit score has gone down. And why did it go down? It went down because his utilization's too high. And he took on all that debt. And so DTI, what's that stand for? Debt to income ratio. So he still has the debt on the house. He might have debt on his auto vehicles, right? He's got his credit debt that he's carrying. And based off of his debt to income ratio, it's too high for him to qualify for any kind of loan. He can't, a solution to Mac's problems would be wonderful if he could get a second mortgage, or even better, a first position home equity line of credit. Either way, that would give him the liquidity that he would need to get all of this under control. But as it is, it's all out of control. So now he finds himself floating bills because he doesn't have enough. And then, well, we have to put more on the credit card, and any little extra that comes in, we have to immediately try to put that onto these credit cards just so there's a little bit there, but then all the money's gone, right? So now you have to go back and do it. So it's like, well, we got this tax return, or we got this stimulus check, quickly pay these bills off, and now it's gone. And then you feel good, wow, I paid those bills because they were going to go into collections, but I'm safe, but I'm still over leveraged. And so this is why you see Max is frowning, right? He's very sad because he saw the credit banking strategy, and it gave him some hope, because he's like, wait a minute, okay, so if I put my income through my lines of credit, then I could start to use these credit cards to help get everything under control. So what happens when he takes his income and he does what we tell him to, and he puts all of that income onto his credit card? So you had a $4,000 balance, he pays it off, bam, he goes down to zero. That's got to feel good.
Right. Yeah, it's good. You're out of debt for the meantime.
But then he's notified almost a week later that his available limit has been decreased from 5,000 down to 1,000. How'd that make you feel?
Well, I mean, a few years ago, I had something similar happen to me, and it was almost like I had lost money.
I know. I mean, you haven't lost money because that's
Right.
money that you
Lost liquidity.
Right. But now, because you put
leverage.
all that money onto the card and then they shrunk your limit, whoa, how did that happen? Why? I mean, we tell people to run their income through their lines of credit, but if that could, why would that happen to somebody who's been in debt like this for over 2 years?
It goes back to the whole banking model that they have to mitigate risk to a certain extent. I mean, there's regulations, and there's shareholders, and there's investors, and there's the Fed, and there's all sorts of items out there in organizations that regulate lending, and you have to reduce your risk in certain situations. And so they have computer algorithms that basically run risk assessments, and when something like this happens, they basically can drop it down, because they know if you had been maxed out for that long of a period, they can drop your limit, because it'll be very quickly for you to remax it out again, and they have you trapped where they wanted you. It's a whole nother world that we got to understand why that they're doing certain things, and it all comes back down to maximizing profit, which there's nothing wrong with maximizing your profit, but the problem comes into when why we're here is to show you how to beat them at their own game.
Right. Okay. So some people have a credit card and they use the credit banking method, and it works just fine.
Right.
Their credit limit isn't shrunk down. Why, when Max tried it, why did it get shrunk down on him? What was the difference between?
He had been running maxed out for a while. That's one of the big reasons there.
Yeah. So at $4,000, a $4,000 balance on a $5,000 card is an 80% utilization rate.
Mm-hmm.
So if I'm at 80% utilization, am I in trouble of them shrinking my limit down?
It depends. It depends on how long you've been in that situation. If this is,
well, what if I put a balance on there? Like I have no balance, and then all of a sudden I have a $5,000 card, and I got to put $4,000 on it this month. But so now I'm at 80% utilization.
Mm-hmm.
But let's say next month I can pay it off. Am I in trouble of them shrinking my limit down?
Not necessarily. But like I said, it's one of those things. It depends on what your history is. But if you're not a what is the word, repeat offender is, I guess, if you're running a track record of being maxed out for a long period of time, and this could be 6 months depending on the card, it could be 12 months if you've been running that extensive balance for some time. But if you're just doing this in a very short term type thing, then you're not as high of a risk.
Okay. So I think one of the things you mentioned earlier was, their computers that they use. So any credit line or credit card that you have, the computer is automatically soft pulling your credit every 6 months.
Right.
And so if they see that your utilization in a 6-month period of time between the last time they checked is above 50% utilization, then the computers are automatically programmed to look.
Yeah, they're gonna be alert to checking that out and seeing what's going on.
So it's not even a human being that's making this decision.
Yeah.
It's all completely computerized. So, so this is another reason why we tell people to, when you watch our videos, don't just go out and run out and try it, right?
Right. Because there's also the ones that I've seen too, and like to bring that back up as I think about it more, I have seen people that haven't used a credit card in a long period of time and then racked up a whole lot. But that can also trigger the other side where it looks like you're in money problems.
Right.
So it really depends on your situation. That's why we want to stress that you don't just run out and do this, that you continue to plug into why this is important to understand. Yes,
definitely. Getting educated is very important. There's a lot of people who hold on to credit cards for emergency purposes only. So they never use it unless there's going to be an emergency. Why is that not a good idea? It's what you just said, right?
Because as long as credit has been extended from a bank, that is on their balance sheet as a liability. And so as long as you have access to that $4,000, that $5,000, even if you're not even using it, that's still a liability on their books. Mm-hmm. And they can't lend that out to somebody else.
That's true.
They want their money to be making money.
Exactly. And so the proper way to be using credit cards is to be using them every month and paying them down either all the way or to have no more than like a 1 or 2% utilization balance carryover. Would you agree with that?
To maximize, yes.
Yeah. Okay. So that would be because if you don't use it, you lose it. You explain that principle, but you can overuse it and carry too high balances and then you lose it out. I mean, this is really how utilization, and there's a lot of other factors that go into determining your credit score. So that's why Max is in this situation. And so he, obviously shouldn't do this, but let's say this is his situation. What can Max do? How does somebody who's really made a shipwreck of their credit, of their personal finances, get out of that? Where's the
start a business?
Where's the rescue boat? Yes, it's time to start a business, right? Just like when I went through 2 foreclosures and which led to a bankruptcy, and everything was spiraling out of control for me. That's when it was the best time to start a business and become a real estate investor. I mean, I'm not saying everybody should go down the path that I went down, but again, this is what I ultimately had to do. So I looked at starting a business, but there are some challenges when you start a business, because we already said 90% of businesses fail in the first 5 years. And there's 3 primary reasons. You know what those 3 primary reasons why businesses fail?
Lack of cash flow.
Yes, that's
Lack
one.
of credit.
That's in the second one.
And lack of collateral.
Yes, that's absolutely true. And so here's what we want to do. Here's the idea behind this. Max on his personal side, he's maxed out. He's in a bad situation. Starting a business, and you never know what's going to go on in the economy. That could be really challenging to start a business, especially because you know that within 5 years, 90% of businesses fail. So and you don't want to become that statistic. So how do you start a business that can create cash flow, build its credit, and have collateral, while at the same time helping to repair your personal side of your credit without commingling funds, right? That puts you even more liable for the debt and could have the IRS come in and audit you and make any money that you borrow now looked at as income that you get even more tax on. I mean, how do you do this and keep this all straight? Well, let's talk about that. It all comes down to building business credit. Business credit is credit that's built on your business's tax ID number. And that's called the EIN, your employer identification number. It's like the social security number for your business. And what's great is when you work with professionals like the Wise Guys and Ties, and you utilize our system and our financial advisors and our loan officer team and all of our, our system that has over 100 different underwriting guidelines for 100 different credit issuers, we guarantee to get people at least $50,000 in lines of credit within 6 to 12 months of using our program. That's pretty phenomenal because how long does it take you to, say your max, how long does it take you to fix your personal credit so that you can get access to $50,000 in lines of credit on your personal side?
On your personal side, I mean.
How long would it take Max to do that on his personal side? Forever?
Yeah, it's just one of those things that it's just a huge uphill battle.
So that is considered 6 to 12 months is incredibly fast in this situation. Now, Max, we don't want him to use his social security number. So we're going to build business credit without using Max's social security number. We're just going to go ahead and have to just, Max, I'm sorry, but that social security number is toxic. We want to stay away from that. Okay, so what are we going to do? Well, we're going to do what Max wanted to do in the beginning. If he could get access to a HELOC, a second mortgage, or a first position home equity line of credit, to get out from under this crushing debt.
Really start to implement that credit banking strategy.
So within 6 to 12 months, we have $50,000 in trade lines, which is vendor credit, revolving store cards, fuel cards, and high limit Visa, MasterCard, American Express, right?
Mm-hmm.
So let's just say of what the business is built, right, that we're just going to use half of that, right? Let's say we get $25,000 in corporate credit cards. Now, what's great is this, when you get issued these cards, they come at 0% interest for up to 24 months, somewhere between 18 to 24 months.
That's awesome.
So here's what we're suggesting. There's a number of ways to do this. This isn't like, if you guys are sitting there writing notes furiously down and doing it a specific, this is just a model for explanation purposes, but you really have 2 different ways to go. The business can either extend a loan or it can extend a line of credit, just as a bank can extend you a loan or a line of credit. So to get a HELOC, right, a home equity line of credit, this is what we're affectionately calling a HELOC, your business home equity line of credit. So how does a business do this? Well, again, there's a number of ways to do this. It's important to have the appropriate documentation, though. You can't just take money from the left hand and give it to the right hand, except for this was my left hand, so it would be giving it to my right hand. You can't do that. That's informal lending, and that will that'll crush you, because what you're doing here, everything that you do, you should have an accountant or a bookkeeper. If that's you, then you need to be doing great accounting and great bookkeeping on all of this. But Max has got that house, remember, and he's been living in it for a while, and he's got some equity. So here's what we're going to do. We're going to go to the title company, and you don't have to use the title company if you don't want to, right? You could just go down to the county and file this yourself, but you have to file a lien against the property, a junior lien, right? You're going to be, so there is a mortgage that's already in place on this house. Max is making a mortgage payment to the bank for the house he's living in. But now that there's equity in the home, you can, based off of how would you figure out how much equity he has? Well, call a realtor, call the property guy. I call the property guy whenever I want to know how much a property's worth. He's better than almost every realtor I've worked with. But you figure out based off of the market, the current market value, what your house value would be like if it was all fixed up. That's called the ARV, the after repair value. And so once you know that value, and then you figure you might need to calculate in some depreciation and the fact that it's been lived in a while and there's some things that need fixed, but it's a complicated formula that Mr. Fleming does really well at because he's educated. But then you can determine what the house, he comes up with a range on the low end and on the high end. This is what the house is worth. And so then you look at how much is owed, and then the gap between what's owed and what it's worth, that's your equity. So that's what you can realistically borrow against within your property. Now, the only way you can get a bank or an institutional lender to lend to you is if you have a low credit score, a high credit score, excuse me. You got to have a high credit score, a low DTI, low utilization. You have to have, good financials over the last 3 years, right? Yep. And anyway, so this is what they look at. And if that's not you, well, then the institutional lender is not going to give you that. Even though you could have the equity there, you can't access it with bad credit. Right. Well, your business doesn't have that same restriction on it, right? It can still lend in that place. So you're either going to take from your credit cards, you're just going to pull out $25,000 and give a loan to yourself, or you're going to take a corporate line of credit and extend the credit card itself, the line of credit, to Max to use for personal expenses. How this is achieved is by writing up a private mortgage note. Now, here in this example, we're talking about a 2-year note, and we put 30% in there. You're paying yourself back. You're growing. I mean, the interest paid is going to be considered income to the business. But whatever it is that you pay, you can set that really low, really high. I want it to be kind of high because you want to show that the business is making good financial decisions, and so that if it's putting if it's giving out a line of credit or a loan in second position, it should be adequately compensated for taking on such a risk. Mm-hmm. Because if the business gave, say, a 5% second position loan, that would make somebody who, if you had somebody in the future evaluating your books, look at that and go, that doesn't look right.
Accounting is key in this.
Exactly.
Like everything in business, though. You really gotta know what you're doing.
Mm-hmm. Absolutely. And, I am educated on accounting. I understand, I've taken math, I've taken statistics, I know it, but I don't like it. And so I have an accountant who loves it, eats, breathes it, sleeps it, does it. So that's great. Let's hire him.
He's a beast. I mean, he's just sitting there like.
And then on top of that, even though I love him, I hire a CPA on top of that to double check his work. Mm-hmm. You've got to, you have to. And this kind of, that's for another day. But you need to hire professionals. You need to learn what your professionals do so you understand what they do, but that doesn't mean you have to do it. You don't have to become that professional. You don't have to become the accounting professional, but you need to understand it so that because if you don't learn this stuff, then you're at the whim of anybody who did learn it, right? If you don't understand something and you don't take the time to learn it, then you're always going to be controlled or at the whim of somebody else who did take the time to learn it. And I don't want that to be you, right? Because those people get taken advantage of. So learn to get educated, learn to get educated. I guess some people do need to learn that education is important enough, right, to do it. But you need to always be learning. And hopefully you're learning something here. So here's what the business does. It's going to create a private mortgage note, and I'm recommending for 2 years because it's a 0% interest rate for the business. So that 30% is going to be straight income for the business. This is a second lien position. And so you can go through a title company. I like going through the title company because it's a complete third-party entity separate from you. So that adds more legitimacy. It means that you're trying to shed more light. You're like saying, hey, look, I'm not doing anything shady over here, right? But you're not doing anything wrong if you go straight to the county courthouse and file this lien yourself. But if you go through the title company, they've got a fee. Make sure you learn what that fee is. It's nominal.
Yeah.
A filing fee is not that expensive. But then you filed in your lien position, and so you can also do two things. You can create, if it's a loan, you can have the title company service that loan for you. Because a loan, see, when you create a private mortgage note, what does that mean? I say private mortgage note. That means it's got a term right here, a 2-year term where it's got to be paid back. It lays out an interest rate, see 30%. And then there's a monthly payment that's generated from that. It could be principal and interest. It could be interest only. You can determine what that amount is. And then, so once you put that all together, right, you've got that's your note, and it's got to be legally enforceable. And if you don't know if it's legally enforceable, that's why it's important to have professionals working with you. You might need to get it notarized in your state. There's a lot of different rules that make sure that you've got to figure out some of these rules, because the jurisdictions, in one state are different than another state. In some states, like say California, it changes per county. You got to know which county you're in, right? So definitely got to do your homework on some of this. But once you create the note, right, this is the proper documentation. This is what's called formal lending. And this is what legitimizes what you're doing. Because if the IRS came in and they wanted to audit you, if you didn't have your private mortgage note, if you didn't have your lien in second position, right, in the note, they're going to check the terms and how it was paid, and they're going to check that against your bank records and everything. So as long as everything's set up right and it matches with what you're doing, you've got a formal loan. That's not going to somehow come back against you. Because if you do this wrong, that $25,000 could be considered taxable income to you personally. Imagine you're already making, like in this case, $60,000 a year, and all of a sudden the IRS says, well, actually, we're going to calculate your taxes now at $85,000, and now you owe a whole bunch of money to the government, and that's not what we want to have happen to you either. Okay, so you got to do this the right way, which is, you hire professionals. You have accountants, right? If you need to get an attorney involved, right, that's always wise. Title company, it's good to, I think, this is what I'm recommending, right? But that's if you do a loan. What if you're extending the line of credit? Well, the title company, they don't do lines of credit. So that means you're going to have to create a whole new type of a book. If you use QuickBooks, you're going to have to create a whole new sub account that monitors the credit account. And here's the thing that's key about this. This is kind of heady, but if you're going to use this as a line of credit, you're going to create a business line of credit, you've got to account for all those expenses that are going onto the card are personal expenses, meaning the business can't, because the business is going to be recording these on the business side. The line of credit is going to show this. You cannot claim anything on that card that's being used as business write-off expenses. That is considered a loan that's out. Right, that's an easy mistake to make. You don't want to do, which is again why something this complicated needs to have a professional taking a look at it. please.
This is a 400 level strategy. But it's one of those things that this is solving a problem for a lot of folks.
Absolutely. So here's what happens. So now instead of putting money on the credit cards, he's going to take that $5,000 and put it into the title company. So in this model here, what we're explaining is, what if this was a loan, right? If you're going to do the line of credit, then that line doesn't go to the title company. It goes all the way over to the business, because then you're just paying the business directly, right? Okay. So, but in this example, if you extended a loan, all right, because that works too, and if Max needed to, he could take the money and create secured lines of credit if he needed to, right? But what's Max going to do really with that $25,000? It's probably going to pay off the car. It's going to pay off all those credit cards and then start rebuilding them. Maybe make a one-time principal-only interest payment on the house, right? These are some of his goals, right? So he puts all, but now he's got to pay this note off. So how does he do it? So he takes all of his money, because say it's an interest-only payment. He's got $500 that needs to be paid. Well, he's going to overpay that, right? And after the bank, after the title company takes out their processing fee, there's $4,950 that's going into the business. Now, that is not income. So if you're doing the books, you can't record that as income. I mean, there's a percentage of that, right? 30% is income, but not all of it.
Right.
However, the gross amount there is considered revenue. And for revenue-based lenders, there are lenders out there that just lend based off of revenue, and they just want to see your cash flow. Then from one respect, you do have $4,950 of revenue, except for 70% of that is just a repayment on a loan, right? So, but here's what's important. The three things a business needs, we've already taken care of. One, there is cash flow. There's revenue that's coming in on a monthly basis to this business that's verifiable through bank statements, but not verifiable through P&Ls or tax returns, because again, there is some income, right? There's a 30% income,
right? But
the revenue looks much larger than the actual income. Okay, so that's good. But let's take a look. How is, I might have to turn the camera off real quick so that people can see that up there. Okay. So here's what happens. Here's what Max is doing. He's got his $25,000. So if he's using this like a line of credit, he puts the income well, okay, so Max is making the payment. Here's what the business does. The business takes the corporate line of credit, takes Max's payment, and puts it all onto paying down the credit card bill. But Max has the credit card. So as you see the uptick go back up, right? So here we are. This is Max's payment to the business. The business puts it all onto the credit card, but then Max uses the line of credit here, right? He puts his monthly expenses on there, but then his $3,000. But then Max makes a $5,000 payment, right? And so the company puts that money down on the line of credit, and Max puts his monthly expenses. So each month he's paying it down, but he's also using it. And what happens is in 11 months, he's paid that all off. Mm-hmm. So if it's a line of credit, he can then use another $25,000. He could rack that all, back up again. And this is something that's really neat, because with a personal credit card, you don't want to use the full limit.
Right.
Because you don't want to go above 50% utilization. That's how Max got in trouble in the first place. But with a corporate credit card, you can go up to 100% utilization as long as you can make the minimum monthly payment.
That's amazing that it doesn't affect your utilization when it's done right.
Oh my goodness. Do you see how credit banking is already awesome, but now it's like on steroids with business credit. So two options. If this was a loan, Max has already in 11 months paid a 2-year loan off. That's cool, because credit banking is so awesome that you can take a 2-year loan and pay it off in 11 months, right? But he could, in this case, just take out that same loan. You can just renew all that paperwork all over again and give him another $25,000, because remember, you have this money at 0% interest for 24 months. Or if he's just using the line of credit, he just then takes out another 25,000. So again, deciding if you're doing a business home equity loan or a business home equity line of credit really depends on, it's going to have a different structure on how you do the accounting for it. But after we do this, and then let's say he does another 25,000, so another 11 months goes by, so he's used $50,000 to not only eliminate all the auto debt and all the personal credit debt, but he's taken probably a significant chunk now out of the money that he owes on the house. So he's even grown the equity even more. Okay, so after 24 months, keep in mind that the computer algorithm that monitors the credit usage, every 6 months, it's checking to see how is this being used? How is this working? And so for 24 months, the computer's made 4 different checks on this business line. And that means you could, because of after each check, you could get what's called a credit limit increase, right? And if we're combining this with the business that's already doing stuff, and the business has multiple credit cards, right? If the business has multiple credit cards, what's important here is, I'm going to turn our camera back on so you can see our beautiful faces. What's important here to see is that the more credit cards that you add into this mix, so the business is using other credit cards, then credit cards compete, business credit, corporate credit cards compete with the other credit card companies to be your primary card. So you start growing your lines of credit up to 150,000. Could be this individual card. It could be a combination of some of the other cards that you have, but they're going to start extending you additional lines of credit. So after 24 months, it is very, very achievable to grow that initial $25,000 line, that corporate line that you started with, up to $150,000. So, I mean, that, in and of itself, that's where we say, hey, look, now we've got some serious credit that's being built. So now we have our second star. So we built some initial credit, and it's just initial credit. The vendor, the store credit, we've got a few of these business credit cards. We might have like $5,000 corporate credit cards that were extended here, how that might have worked. But now these cards are like $25,000 cards now, in just 2 years of using these cards. Now, again, we're looking at our business, and the business is doing well. It's got cash flow in terms of revenue, right? And it's got credit because you've got to use the credit, and it's being paid down more than what it's being used every month. These are important factors. So now the last thing is, let's look at this private mortgage note that's in second lien position. Well, that is considered, let's talk to the property guy. What is that in terms of real estate considered? If you have a second lien position private mortgage note.
What do you mean?
Does this business have any collateral? Does it own anything? Because I mean, the house is still,
any type of secured loan or any type of secured debt is considered an asset.
Right.
Yeah.
But I mean, Max still technically owns the house.
Right.
But so.
But the business though has now, it's almost like a transfer of collateral.
It is. And so that second lien position, so if Max were to default on the loan, the business gets that portion of what the house is worth. I mean, the bank, the first position, gets all of their money, but then
it's actually a powerful concept in the real estate investing of equity stripping too.
That's what I was
I knew that's exactly where you're going.
I was throwing you a softball, buddy.
No, yeah. Equity stripping, I mean, let's just imagine if you had a lot of equity out there, and being less exposed is by reducing how much equity is in there. So if you can't get a HELOC or something along those lines, stripping out that equity reduces exposure.
Absolutely. Because, some people, they've paid off their houses.
Ooh, yeah. And you guys may not even understand that. There are literally people out there that will try to break check somebody with a paid off house. Like there are people out there that literally do that. They plan to do that. It's nuts. Got to make sure you're properly insured. Make sure you don't have all that equity sitting out there exposed.
And it would be good to have some of that equity transferred into a business as well to protect you.
Especially if you have more than one property in your personal name and not in separate assets.
Perfect.
Entities.
So let's take a look at this. Here's something I think is kind of interesting. We started out with a goal of helping Max on the personal side, right, by starting a business. But in the process, our business has cash flow in terms of revenue. It has credit that it's grown over the last 2 years.
Right.
And it has collateral. It has equitable interest that it owns in a real property, in real estate, not real property, real estate. So, I mean, that's great to see the business benefit from that. But what did Max get out of all of that? Well, Max, he saw some huge benefits. His utilization went down because he paid off the credit cards. His debt to income ratio has gone down because he's paid off the cars. He's brought the debt that was on the house down. He's paid off all the credit cards. And so when you bring the utilization down, and if he's, what I'm assuming in this, what's being assumed is now that even though he's got smaller personal credit cards, he's using them now the right way and keeping them all under 30% utilization, right? And so his credit score is seeing a huge boost. I mean, right there, 65% of his credit score just in what we've done. How the FICO score is calculated, we've just in how he's done things, he's just gotten a 65% boost to his credit score.
That's amazing.
So before he might have been somewhere around in the low fives. Now he might be sitting at 680, 700 in 2 years. Imagine that big of a turnaround in just 2 years.
That's phenomenal.
It is phenomenal because that social security number that used to be toxic is now an asset to the business.
Personally guarantee as a business.
See, now you know where I'm going. The PG, the personal guarantee. So the business grew its credit up to $150,000 in 2 years. But because of the benefits that Max received from really repairing his own credit through positive payment history, bringing down the utilization, bringing down his debt to income ratio, he now has, with a 680 credit score or better and low utilization, he has the ability to give a personal guarantee, which would give his business up to an additional $150,000 in corporate lines of credit. I mean, think about that. He was at 150, and now he just doubled it.
Nice.
With a personal guarantee. How cool is that? That is business credit with credit banking. It is a great strategy. There's a lot of little nuances here. It doesn't have to exactly be done all these ways. What I do recommend is that whenever you have a business, give money to your personal side, you have the appropriate supporting documentation to go with it. And on top of that, you should always have an abundance of accounting. If you're the accountant, great. Make sure that all the T's are crossed, all the I's dotted, including all the lowercase j's. You want to be that thorough, right? That because this is something that you could mess this up and it could really go bad for you. Again, like you said,
he's no longer maxed out. He's now maximizing his leverage.
Absolutely. He's happy now because he's using opium. Not opium, the drug, but other people's money. He's learned how to use OPM the right way. Now, here's what I'm talking about with accounting. What you see on your screen is a shot from how this is done in QuickBooks. So, and this is using the method of if this was a line of credit, where you have to keep the interest. So 21% interest was used instead of 30% in this example here. But as you can see, you've got to keep very, very thorough records. Got it? I think it's time to get to our case study.
Whew. That was a lot. That was heavy. That was good stuff.
That was a lot. Hey, we got some folks here, some stuff here. So, we've had some people say, "Hey, I'm Max." Ray, do we get your book when we sign up for counseling? And people are saying, "Yeah, this is good information."
Who we got on there? Antonio.
Oh, yeah.
Absolutely.
Okay, so I'm gonna get to our. Let's share.
Yes, you get the book. Yeah, definitely. There's a little delay in printing with things that are taking place, but yeah, you'll definitely. Anybody that's gotten going in the last couple of weeks will be getting the book.
Is this what we're looking at? No.
Let's see which.
There we go. I know
We're not sharing any screen though. Oh yeah, we are.
Yeah, we are.
Okay.
Okay.
There it goes.
Here we go. Credit Banking Mastermind. We probably want to make that a little bit bigger for folks because we always get somebody who's got weak eyesight. All right. Folks, this is an exciting time when we go over our credit banking mastermind, and I love this time that we really share with you folks because this is your time to shine, right? This is really for you. The first part was instructional, and we go over some concepts, some things to really fire up the imagination and get you thinking outside the bank. But now this is the mastermind session where we really encourage a lot of participation. And so what we're looking at today, and each and every week when we do our case study, is different folks that are out there, people who are part of this weekly mastermind, have shared their numbers, and we keep all of that completely confidential. But what we want to do is we want to give everybody an opportunity to look at a different set of numbers so we can practice what it is we're learning. Because I mean, each and every week, if we just go over this academically, it's nothing. But if you learn how to do this, you practice it, then you can take action in your own life. And that's what we really want to encourage you to do. All right, so let us take a look. Let us see what we shall see. So many times I like to help people understand. Let's put it up there so that what are some things that we're looking at here? Come on, this is the mastermind. So we're already looking at some stuff. We want to think about credit banking. We're talking about credit banking, and let's talk about what do we need for credit banking. What do we need? We talked about this earlier. You need debt, right? We need debt.
Absolutely, we do need debt.
We need positive monthly.
Cash flow.
That's right. Positive monthly cash flow. And last but not least, we need a line of credit or a credit card to credit banking. This is what we need. And so we look at everything we have here, and there looks to be plenty of debt. So check. Positive monthly cash flow. Do we have positive monthly cash flow? Well, here's the income. Let's see. We have people sharing their information here. And of course, I've got, hold on. Whoop. I know. Hold on, folks. Sorry. Oh, no, that's not what I'm trying to do. Here we go. What I'm trying to do is, what I need to do is I need to close out of some of these. I'm sorry, folks. I've got so many windows open that we can't see what everybody is trying to share. Okay, so now let me see. I just want to share my screen. There we go. All right, so we have $630 of cash flow. Good job, Raul. let's set that aside for a moment. All right, so we go ahead and we put in the income here, the expenses of $6,270. And what do we get? $630 of cash flow, just what he said. So this is our cash flow. So we have debt. Let's talk about this. All right. So now we've got ourselves some cash flow. Let's make our cash flow green, shall we? Okay, so we've got $630 of positive monthly cash flow. And now we need a line of credit. And so this is where we look at available credit. This is the limit that they have, $39,000 in their limit. And this is the balance that they're carrying, $27,000 at an interest rate of 21%. So what we need to do is so we do have a line of credit. This is good, but we need to look at what our utilization is. Utilization. Right? We need to see where we're at and where we need to be. So utilization would be taking 27,000, right, and dividing that by 39,000. All right, what answer do we get, folks? Who are playing along with the home game? You guys are like, oh no, this is math. No, I don't want to do math. Come on now, you can do it. What do we got? Who's got the answer for us? Not bad. Yep, credit utilization is at what? Not 1.44. Oh, that is 1.44 because I did that wrong. I typed it in the wrong. I should have put this divided by that 39,000. And that equals 69. There we go, folks. 69.2.
Hey, good job there, Raul.
Good job. Okay. So it's not dollars. Got the wrong thing in there. Okay, 69%. So our utilization is at 69%. Now, we've already talked a lot about utilization today, so we know that that is not good. And we already know what happens if that utilization stays that way for more than 6 months.
Ooh, then we're in bad shape.
We could start seeing the credit limit drop on us, right?
Mm-hmm.
All right, now we're looking at our loan amount. A $521,000 loan, 30 years, right? It started back in November of last year. The interest rate that was typed in here was 21%, but I think that was meant to be the credit card interest rate. I calculated the interest rate based off of the rest of the terms here to be 4.26, but you know, just making adjustments. Mathematically, if that was 21%, we'd want to refi that right away. That's the time when you should refi, right? When your home interest rate's at 21%. So here's the payment, $2,565 a month. Now we look down here at the current situation. We see the mortgage is $2,565 a month plus what's in escrow, which that's usually going to be taxes, right? Insurance, mortgage insurance, right? That could be even HOA sometimes can be put in there.
Yeah, I think I'm trying to remember. I think this was in Texas, wasn't it?
And we don't share any personal information on this stuff.
Oh yeah, that's right.
So this payment is actually $1,000. So it's like $2,600, $26,000, $2,600 a month, right? And so this is going to be that's going to be a lot of money. Obviously, that's being paid. Now, this person who submitted it did their own debt efficiency score. They did it based off of 3,000. I said 2,000, 3,600. So they did it based off of the full payment, and they got a score of 144. They've got this SoFi loan, which is $20,000 balance with a 682 payment, and they got that. They did that debt efficiency score there. And then here's their lines of credit. They got a $17,000 line, a $12,000 line, a $10,000 limit. So 2 credit cards and a line of credit, each of them with a $9,000 balance. And then these are just their monthly expenses. Okay, so we've looked at everything here, and so now I want to throw it out to everybody else here. What do we do, folks? What do we do? This is a mastermind. This is for you. Where would you start? What would you do? Are we going to, I mean, how are we going to do this? You know, we're even opening this up to folks on YouTube. You know, if they've got some thoughts. Ray, would you go and look on YouTube?
Yeah, let's see here.
Okay, perfect.
All right.
Okay, so we have from Raul, who says pay off the lowest CFI on the credit cards.
Cash flow index on the credit cards. Oh, we need to do that. We haven't done that.
You want to look at the debt efficiency on these? Is that what you're saying? So, I mean, real quick. So this would be $400, right? What's the debt efficiency? 42.5. And then this one down here is a $300 payment, right?
Mm-hmm.
So that's 40, not $40. And then this one's well, they put the, let's move the limit over here. Hold on. Oh, wait a minute. No. I'm doing those wrong. I'm sorry. These are wrong because I was basing it off of the limits. I got to base it off of the balances. So what we need is 9,000 divided by 400. Sorry, folks. 22.5. What we need here is 9,000 divided by 300. And that equals 30. And then down here, we need 9,000 divided by, again, 300. So that's going to come out to 30. So I didn't know that. So, you know, if we're doing the, looking at the debt efficiency on these. Okay, so Raul says we need to start with the lowest one here on the credit cards and just start paying them off and then work to the next lowest one and the next lowest one because our utilization is too high.
Mm.
So where do we need to get to? We ultimately need to get below 50%. So if it's 39,000, divide that by 2. So we need to get this balance down to $19,500.
So we got 7,500 to go.
Right. So eliminating one of these cards would be good. Now we have $630 of cash flow to work with. So here, let's say we're going to work here on this one because this one has the lowest debt efficiency. So we need to take 9,000 and divide that by 650. And that gives us 13.8462 months.
All
So
right.
we just round that up to 14. So in 14 months, this card, right? So we'll change that to 14 months. In 14 months, this card is completely paid off. And what happens after 14 months? After 14 months, what happens to this $400 payment?
Goes into the cash. Oh, goes into the cash flow.
Thanks. I'm glad you're a part of the mastermind too. You're so smart.
I have to beat Raul. He's fast.
He is fast. Let's see. I'm gonna check that chat. See. Right. No, he already beat you on it. Yeah. Raul got you. So with the $400, we're gonna go ahead and add that over here. We're gonna add that over here into our cash flow. And we're going to get now our cash flows.
Nice.
Right. And also, if you think about it, it's just another way of looking at it, but we've decreased our expenses by $400, right?
That's right.
So that's where we're at. Okay. So, and we just wash, rinse, and repeat, right? But now we're going to take this next card here, the next credit card, which is $9,000 in blue. And we'll change that back to black. Keep everything consistent. All right, we're going to take this $9,000, right? And we're going to divide it by what was our new cash flow?
1,030.
Mm-hmm. And now we're paying off that second credit card in 9 months. 9 months. How cool is that?
Beautiful.
What happens to this $300? And I'm not really asking you, Ray. You guys saw what happened the last $400.
Added to the cash flow. That's gonna be like 1,330. Thanks, Raul.
Let's see. Raul will probably beat you. Yeah.
Yeah, no, I just read off his answer and claimed it as my own.
Raul's so much smarter than you. Okay. So now we're going to add another $300, which is great because now look at where our cash flow's at. We have to up here subtract $300 from our expenses. So expenses are going down, cash flow is going up. But now we got another, so we got 1,330, and we've got to take care of another $9,000. Of course, let's make that black. But now we've got $1,330, and that's taken care of in 7 months. Boom.
Nice.
And that freed up an additional $300. So over here, our expenses are going down because we don't have to pay that anymore. And our cash flow is going up. Oops. Because we are decreasing our expenses. Perfect.
Nice.
All right. This is a good pattern. So
Good job. Baby.
So if we're adding this all up, 14 plus 9 is 23, and then plus 7, so it's 30. So in 30 months, so it's a 2.25 years, right? 30 months, you've paid off $27,000 in debt. How cool is that? Now this available.
Yeah, 2.5. Yeah, 2.5 perfectly, right? 24, 6, 30.
Yeah.
2.5. 2.5. Beautiful.
Not 2.25. Don't listen to me. Listen to the
2.5.
Listen to the human calculator over there. Right, 2.5 years. Right, we grew our cash flow. I mean, we started with 630, and now we're at 1,630. So we've added a total of $1,000 to our cash flow, and now our utilization has gone from 69%, and it's now down to 0%. Right, so that's good. Now, looking at our debts here, we have this SoFi loan, which is at 29 here. So if you're looking at debt efficiency, do you want to go after the SoFi loan? Do you want to go after this?
Yeah, let's go after that loan. That's but we're also 2.5 years into that loan, so.
Yeah, there's no term on that loan.
Yeah, I guess we'll just have to work with where it's at.
Right. Well,
Let's just, if we just work at where it's at, I mean, that could account for any type of emergency or anything that may have popped up.
if I know the interest rate, I could figure out what the
Right.
term is. See, but I don't know. But okay, let's pretend that that it didn't go down, like they're making interest only payments or something. I don't know. But just for the sake of argument, we need to now pay down a $20,000 debt. Let's make that again black. We got to pay that off using our $1,630 a month of cash flow. Well, what's that going to equal? Huh? How long is it going to take us to pay that off? Did Raul already get that done? Yeah. Oh,
12.2.
man, he is so fast. Okay, 12.2.
There you
So we're not, billing cycles are monthly, so we're going to have to round that up to 13. But 13 months, right? So a little over another year.
Mhm.
So now 2.5 years, 3.5, a little over 3.5 years, and you've eliminated everything except for the house, and you've now freed up even more cash flow. Let's move this out of the way. And so now, what are we doing? We're decreasing our expenses by where
like
was it?
682.
682. That's right. So 682, and now our expenses are down to 4,588. And then we take, let's look at our cash flow, and now we're going to add. We're going to add 682, and that's going to equal.
Boom, good job.
Man, did Raul get it right?
Yeah, he had it like 5 minutes ago.
Hey, well, this is on the screen for everybody to see, but how come Raul, did you guys like all nominate? I mean, there's a lot of people here in the webinar. There's 9 people, and Raul is the only, did he get like nominated to do all the math for you guys today? I mean, Jamar, Antonio, where are you guys?
Raul's imaginary.
Okay, you guys are funny.
It's fast.
All right. Okay, so man, now we got to look at this house. And so we have been paying on it for 14 and then 9. All right, so that's 30 months. And then now we're at 43 months. So 30 years is 360 months. And we've paid, and we, what, 43 months now?
Yep.
That's 43 equals, so now we have 317 months left on this loan. Oh, but that was back in November. So we've got December, January, February, March, April, say May. So we got to subtract another 6 months for that. Oops. Well, we obviously know that that's 311, but put it in there for the people who are watching, who don't have audio, right? Oh, no, we're not subtracting 311, we're subtracting 6. That's going to give us
311.
if I can do things the right way.
Whoop.
Oh man, why do I even bother?
Just change the 43 to 49.
There you go.
There we go.
Ah, I love technology. It's awesome. So now we have 311 months left on our 30-year loan. Interest rates at 4.21%. We have our payments here. So I think it's time to switch over to our credit banking calculator and take a look at this. But you guys can see that normally all you do is you look at your balance and you divide it by your cash flow. But you know, let's take a look at this. Am I sharing my screen or just this? Okay, good. I'm sharing my screen. Good. All right, so I'm bringing up the credit banking calculator.
Perfect.
And so everybody can see that. So here's what I want to do. I want to put in the balance of the loan, but we've been paying on it for a while. So let me use my handy dandy real estate investing calculator here, folks. If you don't have one, you got to go out and get yourself an HB 10B2 calculator or get the app for your smartphone. So let's see, we put in, yeah, perfect. Yeah, okay. So we have that. So now I've already put the numbers into my calculator. So now we want to see what is our balance at at 311 months. We paid down, it's now going to be $482,705. Wow. Okay. So $482,705. You know, we started at 521, and so, you know, it's only been paid down a little bit. Okay, so we're at an interest rate of 4.26. All right, and then that puts our payment rate at let's see what we got here. 2,565, and this says 2,400. So you have a discrepancy. Okay, so
All right, got an interest rate.
if that was 5. That's too much at 5. It's 2.6, so we got to get that down. So let's do 4.5. Oh, we're right there. Let's do 4.6. Sorry, you know, when you send in your information, if you give me the actual interest rate, then this stuff works. But I gotta play around with it till we get it. So it's 5. Oh, we're really close. So 4.65. Let's look at that. Oh, 4.6. Oh, what did I do? Oh, come on now.
Percent.
No. Let's do 4.7. And there we go. Now we got our number. Okay, so 4.7. Okay. Here we go. So now we got to put in they're at a 21% credit card interest rate. Their income is $6,900. And really decreased the income down to $4,588. So let's see how we did. Yep, our cash flow matches perfectly.
All right.
All right, folks. We got it figured out. What you're seeing on your screen here is a graphical representation. The blue line is if you just continue to make your payments. It'll take a little less than 350 months. It'll be 344 months, and you'll have that paid off. If you were to take an extra $500 a month, and put that towards each monthly payment, you would pay it off earlier. You'd pay it off
almost 8 years earlier.
Yeah, and you'd save yourself $126,000. When you use a basic credit banking method of paying down your mortgage, look at this. Instead of it taking 28 years, it takes 11 and a half years. So we've already been doing this for a while now, but now we've been accelerating the debt pay down of all the other debts, increasing the cash flow. So we've maxed out our cash flow to be able to take this out in 11 and a half years. It was going to take 28.6 or 28 years and 2/3 of another year, right? But look at this. You're saving $241,000. I mean, that is incredible. Now, again, we don't really on this program go over the advanced credit banking strategy. Well, we kind of did today, right? The whole first part of your training,
Yeah,
that's an advanced credit banking strategy. Whenever you can get a HELOC or you create a HELOC through a business, you can accelerate your pay down because, I mean, there's all kinds of great interest rates that you can get. This is what you would get for a first position. Notice we were doing a 30%, but we were in second position.
Right.
But if we were in a first position home equity line of credit, we could give an outstanding rate, let's say 4%. And the great thing is when you start doing a basic credit banking strategy, as soon as you free up 40% equity in this house, you can then switch over to an advanced strategy and pay this off even sooner. So you could shave this down. It is possible to get this under 10 years, right? But again, you'd have to get a home equity line of credit once you reach that 40% equity. Now, I've had people ask me, well, how do I get that? My bank doesn't offer it, right? Yeah, if you're with Chase, Bank of America, Wells Fargo, US Bank, right? If you're with the big banks, right? They don't offer first position home equity lines of credit because they make all their money in the mortgage, the having the loan. They're going to make more money keeping the loan in place. It's your regional banks and your local credit unions that offer those great products. So it's usually the big banks make their money on the loans and the small banks make their money on the lines of credit. So that's where you want to go to find one of these things. But this is a great representation of how this works. But I want you to keep in mind, let's full disclosure here. This whole system assumes that your income is not going to change. Like is your income going to stay the same over 28 years or 20 or 11 or say the next 10 years? Is this income going to stay the same? Not likely. And your expenses, this system also assumes that your expenses are not going to change. Is that realistic either? No. But this gives us a snapshot to look at where we're at. So let's say your income goes down, your expenses go up, you readjust. And then life happens and then your income goes up and your expenses go down, right? You readjust. And so this is something where we look at the average of your life. I mean, usually through someone's life, they continuously begin to make a little bit more and a little bit more as they go through life on average, right? I mean, you start at minimum wage, say at age 16, hopefully by the time you're 65, you're still not working for minimum wage. It's possible, but usually you've gained some skill or some knowledge or you're able to increase that income. But also through your life, you started out single and then maybe you got married and then you had kids and you took on a lot of debt. And so your expenses go up. I say all that to say, because
so we got some people that will ask, why don't we just in the second situation, take all your free cash flow and throw it towards that?
Okay. So all this cash flow here. So
the 1812 make a total of the 2312.
Right. 23, 12. Look at that. Doesn't it? Hey, it gets done even faster than your credit banking. So you're like, well, why would I even waste my time with credit banking? Well, okay, let's look at this. This is a great thing, but what you're doing, if you do this, is you're taking all of your liquidity, all of your extra money that you have, and you're putting it into the house.
Mm-hmm.
You make that payment, that money's gone. You don't get it back, right? You're not using a line of credit, keep in mind now. So there's no liquidity. You're taking all your extra cash that you have and you're giving it to the bank. Where's it going? It's going into the equity of your property that you really can't access until you've paid that down.
Let's say an emergency comes up. I can't go to the bank and just access that?
No, I mean, you'll have to wait until you reach, usually the point is 22 years into the loan. Now we're already a number of years into this loan. So let's say you need about 18 years into this loan, you can begin to access a second mortgage and start to pull some of that money that you've put into there out, but you've got to wait to do that. So what you're doing over the course of time, well, I mean, 18 years,
It's just there's no cash flow.
you're paying this off in 10 years. So I'm sorry. So what we're going to say is you're not going to be able to access this money that you're putting in for 5 years, right? Because you're going to be paying down, and you're going to have equity in the property. So you need 5 years of just putting all your money in there. And so you can't have anything go wrong, right? Nothing can go wrong because you'll have credit. You have to put it on credit. Now here's what happens here. When you pay this off using a credit banking strategy, you're using lines of credit. What this does for you is you convert your cash into available credit, so you don't lose any of your liquidity. And this grows your line of credit because over 11 years of doing this, your credit cards aren't going to be at those balances we saw, the 12,000, the 10,000. These lines of credit are going to grow. They're going to double or even more in size over this period of time. You're going to have access to more credit. You're going to have better interest rates. You're going to have a huge, what's called payment history that you can utilize to go out and secure more lines of credit. The other way, you haven't leveraged anything but your own income, and so again, you're in a tight position. So you're like, well, but I still have a credit card.
That's when you get put into a bad situation and then start racking up your credit card debt.
Right, because if you get rid of your liquidity and you start putting in an emergency money on your credit cards, then you're like, well, then I'll put my free cash flow towards the credit cards. Well, then that number isn't going to work out just right for you. But ultimately, what a basic credit banking strategy is going to do for you is you're going to utilize other people's money to pay down your debt while keeping the maximum amount of liquidity available to you. Because if all of that is important to you is you're in debt, you're in the negative, and you just want to get back to zero, then look, yeah, that orange option is like the fastest one.
Yeah, like Prime Fire says, the credit line is almost as fast. Plus, you get all these extra benefits.
Right. I mean, think about this.
You get all that huge liquidity benefit.
But when you use your credit cards and you're making all these payments, you get flight miles, you get cash back points, you get fuel points.
Oh, yeah.
There's so many other additional benefits that come in to using credit cards. And plus, it opens up new lines of credit. But over here, this is at the end of the day, you've gotten out of debt, you're back to zero. And if you didn't use your credit cards, because you're not using your credit cards over here, you're also going to see those credit cards and those lines shrink. So here you are after 10 years, let's say, and you've gotten out of debt. Your credit card limits have all shrunk. Your income to debt ratio's gone down. That's good, but you don't have enough credit history, so you can go out and try to get, say, a HELOC over here, and you probably get one, but without an extensive banking history, you're not going to get this low rate here. You're going to get 12%, right? Probably. See, when you utilize a credit banking strategy, there's so many additional benefits. Just like when we were showing you Max earlier, how he benefited in so many different ways. I can't stress enough that you can use your own money to pay down all your debts, and let's just say that is a legitimate option. I think there's a better way, but that's a good option. Okay, if you can free up the cash flow and pay down your own debt, and you want to do that, that is fine. If you want to learn how to leverage lines of credit and you use them the right way, right? I mean, we're not using these credit cards to go on trips or to buy TVs and
shucks.
and all these things that we want to do. No, if we utilize the credit as a tool, we can grow the line of credit. And the ultimate goal here, if we follow the rules, let's switch back here. I mean, we gotta follow the rules, right? What are the rules? Line of credit rules, right? Number one, your lines of credit are for emergencies, Emergencies. Number 2, it's for debt pay down. And then number 3, it's for assets. See, when you use your line of credit the right way in paying down your debts, you grow these lines of credit so that you can now have the liquidity necessary to purchase major assets, to purchase rental properties, or to purchase, because I mean, you don't have to pay for everything cash. You can leverage a very small amount. I mean, you're really good at the subject too, of getting into a property with little to no money. And so now you've got control over a property. It is being able, imagine having a credit card and being able to have the liquidity to be able to say, you know what, I'm going to take $9,000 and I'm going to go buy a $250,000 house subject to.
Which brings up a really good point. For the folks that are on the line right now, if you're watching and you're wanting to dive deep into real estate, make sure you're here Thursday night, because we're going to start touching base on some creative acquisitions on how to purchase real estate without using any of your own money or credit. So if you're really enjoying the credit banking masterminds, we got the real estate masterminds as well that will be taking place live Thursday evening, 6 p.m. Pacific Standard Time. Little plug there.
I think it's a great plug. I'm excited about that plug. I think I'm sharing my screen.
I believe so.
Folks, we've really kind of gone over our time today, but this was just so exciting. I can't help it. And if you're still with us, you know, God bless you. We love you. We love having you. There's so many great things to learn here. But we want you to know that if you want to participate, you want to be a part of this mastermind, all you have to do is go to wiseguysandties.com, right? /credit-banking, right? You can participate in our Tuesday masterminds. You know, there's a lot of people here in our mastermind, and you know, I give our shout outs. We've got Jahan, we got Antonio, Brian, Felicia, Gabrielle, Glenn, Jamar, Lou, Raul. I mean, just to name a few. I mean, we've had a lot of people come in and out, but I just I'm so grateful to all our folks, and these folks, they get additional benefits, because I mean, if you like some of the resources we're using, like the credit banking calculator and being able to go over your individual numbers, it starts by joining the webinar, right? Getting in on the mastermind. And so all you have to do is put in your name, your email address, your phone number. We don't share any of your contact information with anybody, and we only contact you if you want us to. But you need to check mark the 4 boxes. And then as you scroll down, if you want to participate in the mastermind and have us go over your numbers, you just put your numbers in here. This is just some basic information. If your situation can't be defined in these few boxes, you can come down here and let's say you typed it out on a Word document, copy, you know, and to paste the content right there in the current situation. And then we'll go ahead and so this is also how you can have a one-on-one free consultation with us as well, where we love to go over and help you as well. But this is also how you, if you want to just participate in the mastermind, we don't include any of your personal information, and we're able to definitely, you know, what's great is you can have us take a look at it, but I mean, like, you have so many other people here that have great ideas. And really, you know, Raul, especially like today, he's showing that, you know, we could bring him in and he could run this mastermind, right? People in this mastermind, they're getting it. And that's great to see. All right. So I get man.
Oh yeah. We'll get you. We'll send that off to you.
Oh, you don't have that yet? Well, you have to beat Ray in a math race. All right. Like there's spelling bees. We're gonna have a math bee, and whoever is the fastest Raul gets the credit banking calculator. We'll get that to you. All right, folks, thank you so much for having us out here. You know, I want to thank again the Velocity channel, it's CJ Wallace, for having us out there on YouTube. We love to bring this credit banking mastermind to you each and every week. I want to thank everybody who's been a part of our mastermind today. I know you guys all voted for Raul to do the math for you, but I hope that you got something out of it. And if you were blessed by anything that we shared tonight, if this really just started to just fire your brain, fireworks were going off, we want you to like and subscribe to the YouTube channel. Now, if you're watching other YouTube channels, like and subscribe their content because we guest star on other YouTube channels. But go seek out the Wise Guys in Ties and like our content, because what that does is that tells YouTube that this information is important, and then they'll push it out for other people to find. And that's what we want to do. We want to help people who are stuck. If you're Max yourself, then help us spread the word. Help us we want you to be helped and blessed as well. But if there's other people that you know that need this information, the only way we can get it out to them is if you like and subscribe to our channel, which is wiseguysandties.com. We thank you for your support. We hope that you've been blessed. If you do want to get a free 30-minute consultation where we can go over your numbers, reach out to us at 888-524-9273 or you see our email address and our websites on the screen. I want to thank you so much for being here. No matter what's going on, right? The economy's up, the economy's down, everything's crazy. What's going on? Look, when you learn credit banking, when you learn business credit, what you're doing is you're creating your own economy that you can control. All right? That's what we want for you. We want you to take back control and not feel like you're at the whims of whatever they're trying to decide in Washington to do, or whatever your job or your boss or what they're trying to decide to do. Let's take back control. Let's reclaim that. Let's claim our financial freedom, and let's do it together. I want to thank you so much on behalf of myself, Joseph Smith. This is Ray Fleming.
Good night, everybody.
Good night. God bless.